What's going on, guys? Welcome back to the channel. In today's video, I'm going to be doing a very quick video on how you can identify and trade deviations and why they are one of my favorite setups to actually take in any market. So here's an example on Ethereum US dollar for two perfect examples of deviations. Now, what is a deviation? Essentially, it's just a fancy term for a fake out. It's when you create a very tight range, you break out of that range, but really it's just a fake out, and then you shoot right back up into that range. Essentially, it's a liquidity grab where you fake everybody out, trap everybody into a position, and then jump right back into the range. So how can you actually trade, and how can you identify a deviation in the market? Okay, so let's just scroll over here real quick, and essentially how you can trade a deviation is something like this. It's when, let's say you have a price come down, like in this example in Ethereum, you're trending down, and then all of a sudden you start to form a very tight range. Okay, you're ranging and you're consolidating in this market. Now we can go ahead and we can mark out this range, right? You can identify the consolidation in the market, and then let's say all of a sudden you break out to the upside of this range. What's going to happen when you break out to the upside of this range? Well, essentially a whole bunch of people are going to start taking longs as soon as you break out because they are anticipating more upside. So you have a whole bunch of people basically entering the market anticipating more longs and more upside, and essentially what happens is those people end up getting trapped in their longs because all that liquidity gets sucked up into the deviation, and then you break back down into the range. Now, how can you actually trade a deviation? Well, if you see price break out and then actually break back down into the range, you can expect with a high level of probability that price will actually go and fill the bottom side of that range at the very least, and then maybe actually break down the opposite direction if there is enough momentum in the market. So a deviation, when you spot one, is a very high probability trade setup, and you could see that it played out here perfectly 2 times on Ethereum, and both time would have been a very successful high risk to reward trade. So what I identified in the market on this bottom deviation here is that we were actually in a range, right? So at the time, all I really saw was, let's go ahead and do a replay. Where's the replay button? Here we go. All I really saw was this. Okay, so I knew that we were in this sort of consolidation after a big downtrend. We were in this consolidation, and then we broke out to the downside and then immediately came back up into this range. As soon as we came back into this range, I knew that tons of people were trapped inside of shorts. So as soon as price broke down right here, a bunch of people started shorting aggressively. Price came down, and then all of a sudden price came back up, and all those people are now trapped in their shorts, and they're forced to close out. Either they get liquidated, their stop loss gets hit, or they're manually closing out their position because they see that price is going against them. Now you can use that momentum and actually predict that price is going to go ahead and fill the top of this range. So what I did was I entered longs right here. I put my stop loss below the bottom of this range, because if we end up coming back down, that's not a deviation anymore. It's actually just a failure to the upside, and then we're going to end up coming back down. So the invalidation is very clear below the bottom of the range, and I expected us to actually come back up and fill the range. And that what you can expect also is perhaps with enough momentum, you can even come and fill a higher target if you want to leave some runners. And if we actually get rid of this replay, you can see that that is exactly what happened. We actually came back up into this range, and we eventually filled the entirety of this range, and it was a very nice successful long. The same thing happened here to the upside, right? So we break out to the upside, everybody gets very excited and starts longing with leverage very late. All these longs get trapped, price comes back down into the range, and now you know at that point that there is very high probability shorts to actually take to the downside. Now, I did not get these shorts today, but still, if you were to take them, those would have been very profitable shorts, because anytime you deviate from a range like this and come back into the range, you can expect that the bottom side of that range will most likely get filled, right? This is just a game of probabilities, and you could tell that when there's a deviation, that is a very high probability setup. So that's how I identify and trade deviations. I hope this video helped you identify deviations in the market, and maybe it'll actually prevent you from being one of these people that get trapped into a late breakout, because breakout trades are some of the sketchiest trades that you can take for this exact reason, because everybody's anticipating this breakout, everybody jumps into longs or shorts late after the breakout, and it is a very high probability chance that you actually create a deviation, you fake out to the downside, and then end up getting stopped out, and all that momentum causes price to continue down further. So I hope this video helped. Quick little education on how to identify and trade deviations, and I'll see you in the next video.